Hey, Saretsky here. As always, Canadian real estate market update with particular focus on Vancouver. If you're getting sort of value and entertainment out of these videos, all I ask you hit thumbs up and subscribe. Questions, comments, put those below. I want to touch this week on the Bank of Canada's rate hike. Raising rates 25 basis points, the first time since 2018. I also want to jump into what's happening in the commodity markets, how I see that feeding through into the consumer sector, and ultimately how that filters through into the housing market. Because if you watched my video last week, you know that my views, I've updated my views on the housing market. I think that the outlook for housing is not overly optimistic. You had the green light to basically lever to the hilt over the last 18 months. I think that green light is clearly shifting as we get our first rate hike here from the Bank of Canada. So if you watch the Tiff Macklem presser, basically, normally I would say, hey, let's clip into Tiff Macklem's comments here. But to be honest, I watched the whole press conference and there was nothing there. The guy is extremely boring. All of his message was pre-canned. All of his answers were like pre-canned. And so ultimately what he was basically saying was he was a little bit more on the hawkish side than I expected him to. He didn't lever too much on the Russia-Ukraine scenario, basically saying, listen, we're going to raise rates. We're going to fight inflation. And so I think it's one important is to understand and explain again how central bankers work, because I had people texting me before the rate hike announcement saying, oh, he's not going to raise rates, watch. And this was so priced in, 25 basis point move, that central bankers care a lot about inflation expectations. And so when you've got inflation running at 30-year highs, if you don't make it at least look like you're doing something to begin fighting that inflation expectations can basically become unanchored, i.e. psychologically people will then say, hey, like inflation's going to get worse, it's going to get out of control, I'm going to start demanding a higher wage, higher salary, businesses are going to start raising their prices on the anticipation that prices will continue to rise. So central bankers have to keep those inflation expectations under control. And so you have to at least raise rates a couple times in the face of what we're looking at. And that's why my view is still 3 to 4 rate hikes this year. I think they're going to go until something breaks. I think something breaks sooner than most people anticipate. I know the markets are pricing in 6 to 8 rate hikes. And so everybody, again, keeps saying, well, just you wait. This is the Paul Volcker moment. And again, if you're not familiar with Paul Volcker was the head of the U.S. Federal Reserve in the 1980s. He was charged with he was the one that was responsible for fighting inflation. He had to raise rates, I don't know what he got to, 13, 14% overnight interest rate in order to squash inflation. Everybody hated him, but he did the hard work that needed to be done to bring inflation down. So everybody keeps saying this is the Paul Volcker moment. Well, I'm going to point you to this chart here from David Doyle, Macquarie Research. David's extremely well respected in the industry. And he's put this chart up which basically highlights, when you account for private debt in Canada. So if you assume 6 rate hikes this year, which is kind of what markets are pricing in, and you account for the level of indebtedness today in the private sector compared to other decades or other eras of rate hike tightening cycles, is that by raising rates 6 times this year, so 6 times 25 is 150 basis points. This will be the equivalent to the last time. It would be equivalent to the 1980s. So the last time that would be tightening conditions this much would be equivalent to the 1980s. So basically, again, what we're saying is that the Paul Volcker moment today is bringing rates from 0 to 150 basis points, bringing 0 to 1.5% on the overnight rate. Again, from a historical context, 1.5%, well, that's extremely low, but that's all it's going to take to extremely turn the screws on this over-indebted, not only global economy, particularly here in Canada. And so that is really the crux of, when I say, hey, I think it's 3 to 4 hikes before something breaks, I'm looking at it from that angle. I'm not saying that they shouldn't go 5, 6, 7, 8 rate hikes. I just think once they hit that moment, that's when they ultimately, you stop talking about inflation, you start talking about deflation, and you start talking about recessions and job losses and how you get out of that. And that's when you're looking at easing of monetary policy. So which kind of brings me to the next point, right? So like people are saying, okay, let's talk about the central bank. They're raising rates. we see what's happening in Russia, Ukraine. I mean, look what's happening in the commodity sector. So, great chart from Jim Bianco, which is basically, he says, not every recession is led by a 50% rise in crude, but every 50% rise in crude oil has led a recession. So all we have to do is look at oil prices. I mean, we're over $100 a barrel now, even for Western Canadian Select oil, over $100 a barrel. Here in Vancouver, you've got gasoline prices. We're filling up at $2 a liter. It's expected to go even higher this week. Not only that, but the BC NDP is now coming in with their increase of their carbon tax there, which is going to add more points to gasoline prices. So people fueling up at the pump, it's going viral, going, oh my God, look at this. Not only that, but you've got, take a look at the chart on grain prices. So, Russia, Ukraine are huge global suppliers of, grain. Not only that, but that filters through into fertilizer. So long story short is, I'm like, okay, well, how do you paint a bullish picture for, let's say, the Canadian consumer? Let's keep it local. You've got, rampant gas price inflation, which is extremely vital to everyone's day-to-day lives. You've got food inflation, which is already high and is going to continue to ramp up even higher. And now, as a central bank is raising, is taking the option to raise everyone's debt servicing payments. Like, this is like, you would think about it, you're like, wow, this is the ultimate squeeze. So it's like, how is any of this bullish or optimistic for the Canadian consumer? They're getting screwed left, right, and center right now through higher prices, wages that aren't keeping up. And now the Bank of Canada is tacking on, hey, all that record level of debt you got, guess what? You're going to start paying more. And so paying more is exactly what they're going to do. The 25 basis point move, for example, on your variable rate mortgage is equivalent to about another $12 to $13 per month on every $100,000 of debt that you have outstanding. Of course, we know that fixed rate mortgage has been creeping up around 3% today. So, and that's why we're starting to see, again, the housing market starting to turn and pivot, because ultimately we've had this 2-year bull market, and now that you've got inflation combined with hawkish central banks, which are now raising rates, it's kind of this perfect storm. And so I've been basically arguing that I think markets are going to do the majority of the tightening for the Bank of Canada, i.e. oil, for example, is going to do it for the Bank of Canada. Rampant oil prices is going to slow consumer demand and consumer consumption, right? As food starts going up, as gas prices start going up, you're going to slowly start to trim wherever sort of expenses you can in different areas, and that is ultimately going to filter through. So that's kind of my view, which ultimately filters through into housing, right? Again, we talk about central bank sort of moral suasion or forward guidance. Well, again, if you go back to the start of the pandemic, right? What did Tiff Macklem say to everybody? Start of the pandemic, he was like, listen, guys, we're going to drop rates to 0. And we're going to keep them there for a very, very long time. So if you need to go and borrow to buy a house, to start a business, to finance a boat, don't worry, rates will stay low for a very, very long time. i.e., this is the green light to go and spend. Don't worry about interest rates. We're going to keep them on the floor for a long, long time. Now what is he saying? Oh, well, listen, Canadians, we need to start raising rates. You can be rest assured that we will keep a steady path for rate increases moving forward. This is like the red light to stop speculating on the housing market. So that's basically just how I'm looking at it. It's like, just watch these guys. I think they should have started raising rates 6 to 8 months ago. And they're too late now. The financial markets will do the tightening for them. That's really how, my view right now on everything, is that this is going to lead to a policy error. You could argue that the error was done previously, but that's really how I'm looking at markets today. Is basically you've got the Bank of Canada, which is just beginning their rate hike cycle, as the housing market is already peaked. It peaked last month, okay? For all of you that you want to know what's the inside scoop on the housing market, listen, I don't care, what your realtor told you, your neighbor told you, your dog told you. The housing market peaked last month, okay? And so he's just beginning his rate hike tightening cycle as the housing market, as that happens, as a war breaks out, and commodity prices, which again is part of our day-to-day lives. Oil is the lifeblood of the global economy. It's in everything that you use. It's in this video recording camera that I'm filming this on right now. As that rises, that input cost, that oil input cost, makes everything more expensive. And basically, before every recession you've ever seen, oil prices always rip, and that leads to a drag on economic growth. And so that's important to understand, because as that filters through into the housing market, people have less money to spend. People start tightening up their belts a little bit. Maybe I'll get a little bit smaller house. Hey, mortgage rates are going up. Maybe we shouldn't stretch as much as we initially were anticipating. So that is how that all filters through. Keep in mind that markets are predominantly psychological. So much of markets sentiment based, and I think that the sentiment clearly has shifted and is shifting, and so that's what I'm watching this week. As always, hope that helped. We'll see you next week.